Okay, you guys, we're now going to take a look at problem 11-3A on page 534. We'll go through some journal entries for a corporation dealing with their equity accounts. Let's read through it first. They say the following selected accounts appear in the ledger of EJ Construction Incorporated at the beginning of the current fiscal year. Okay, they have preferred stock. Now, in the lecture video I mentioned that means the owners of preferred stock have first claim to dividends if the board of directors of the corporation ever votes to pay a dividend, which is again a return of the profits of the corporation to the shareholders. The state has authorized, and their preferred stock is 1%. That means if dividends are declared, the preferred stockholders would receive a dividend equal to 1% of the $50 par value, or 50 cents per share. The state has authorized them to sell 100,000 shares of preferred stock. So far, though, to the general public or to the investing public, they've only issued 80,000 shares. Now, those shares will go on the books at par value. So if you've got your calculator out, say $50 par times the 80,000 shares that have been issued, and you'll get the balance in the preferred stock account, $4 million. Again, take your par value, $50, because these shares are always placed on the books at par value. And you guys, these are all stockholders' equity accounts. I think I mentioned that. Say the $50 par times the 80,000 shares issued, and you get the balance in the preferred stock account, $4 million. Now, if these shares, when they are sold or issued to the investing public, if the price received is above $50, then any cash received above par value is placed into this next account, paid in capital in excess of par preferred stock. There, the balance at this time is $175. Okay, common stock, which is generally what we're talking about. If someone says they own stock, you can generally assume it's common stock of a corporation. The $3 par value has been assigned here. 5 million shares were authorized by the state. So far, only 2 million shares have been issued. Okay, and in these shares, just like the preferred stock, the common stock shares would go on the books at par value. So again, with your calculator, say $3 par times the 2 million shares issued, and you get the balance in the account, $6 million. Okay, it also has an associated paid in capital in excess of par common stock account. We would place any amounts received above $3 per share into this account. $3 per share being the par value for the common stock. And then retained earnings, we've talked about it already. It's increased by net income, decreased by net loss, and also decreased by dividends. Okay, they tell us during the year the corporation completed a number of transactions affecting stockholders' equity. They are summarized as follows. On A, issued 500,000 shares of common stock at $8, receiving cash. Okay, so let's start with A. I'm going to use the letters as dates. Right on A. Well, what do we now have more of? Issued 500,000 shares of common stock at $8, receiving cash. That means the corporation issued some new shares of common stock, a total of 500,000 shares, and they sold those shares for $8 each. So they now have more cash. It's an asset that increased. Assets increase on the debit side is equal to 8 times 500,000, which gets us $4 million. Okay, common stock is a stockholder's equity account. It increased in this situation. They increase on the credit side. So we're going to credit common stock But it's going to go on the books at the par value. Well, the par value for the common stock is $3 per share times the 500,000 shares issued. The credit to common stock under an increase to the common stock account for $1.5 million. Then that difference, the excess received above par value, which in this case comes to $2.5 million, is going to be used to increase the account paid in capital in excess of par dash common stock. And I'll abbreviated common stock there, of course. Okay, so there's a couple ways you could go about getting this number. You could just say the $4 million that the cash received less the amount, the par value amount assigned to the common stock shares, and we'd get $2.5 million. Or what was the difference in the price received per share and par value? Well, they sold these shares for $8 each. Par value was $3 each. That difference is 5. So we could say 5 times the 500,000 shares issued, and that also gets us 2.5 million. Okay, so there's just a couple ways to go about that there. I'd probably try it both ways, make sure you get the same answer either way you go. If not, figure out what you're missing or doing incorrectly. Okay, on B, issued 10,000 shares of preferred 1% stock at $60 per share. Guys, this one's handled really the same way as A, except here we're dealing with preferred stock rather than common. They've issued new shares of preferred stock, which means they now have more cash. It's an asset that increased. Okay, how many shares were issued? 10,000 shares. Times what was the issue price? $60 per share. So we're going to increase cash by 600,000. Okay, the stockholders' equity account preferred stock increased. Stockholders' equity accounts typically they're going to increase on the credit side. Okay, we will place preferred stock on the books though at its par value. The par value there is $50 times the number of shares issued, 10,000. We're going to credit preferred stock for 500,000. So the account we're going to credit for the difference, that's for the amounts received above par value for the shares when they're issued, paid in capital in excess of par dash preferred stock this time. Sorry, I can't seem to type and talk at the same time. Two ways you could calculate this one as well. You could just subtract, so it's going to be a credit for 100,000. If you want to check your work, these shares of preferred stock were issued at $60. Par value on the shares is $50, so that's a $10 spread. So it's equal to $10 times the 10,000 shares issued, 100,000, either way you calculate. I'd check it that way, you guys. That way you feel more comfortable about your answer. All right, let's go to C. Corporation purchased 50,000 shares of Treasury Common for $7 per share. We're calling it Treasury Common here. Sometimes you'll hear it called Treasury Stock. That's where the corporation, in this case EJ Construction Incorporated, went out into the open market and purchased shares of their own stock. It would be just like if Coca-Cola, the corporation, purchase shares of Coca-Cola. So the corporation can own shares of itself, in other words. And that's what this company is doing here. It says Treasury Common, so that means the shares that they purchased were common stock shares. And we're going to put those Treasury stock shares on the books at their cost, you guys. We're going to debit Treasury stock. Or how much did we pay? How much did the company pay out here? 50,000 times 7. $350,000. And they bought the shares, so they now have less cash. An asset decreases on the credit side. Okay. I like to know, in this case, the price per share. I'm going to calculate it over here. Because we put Treasury stock on the books at its cost. Later on, when it's sold back to the investing public, we're going to take it off the books at its cost. So I want to know what we paid per share here. So I'm going to say $350,000, the amount paid, divided by, they give it to you anyway here, right? 7. Excuse me. They give you the price here anyway. It's irrelevant. In the previous text, we had to calculate it. No problem here. I'm just going to put in cost. $7 per share. What I meant in the previous text, they'd say purchase 50,000 shares of Treasury Common for $350,000, and we'd have to make the calculation on the other end. Sorry, I took you through that pointless exercise. But Treasury stock is it's a contra stockholders' equity account. Stockholders' equity accounts increase on the credit side, like paid-in capital, any of the paid-in capital accounts, preferred stock, and common stock. The contra stockholders' equity account is going to increase on the debit side. It's important to know that cost per share here, though, because as we sell the shares, we'll take them off the books at their cost. Okay, let's do D. And I think that's what's going to happen. Sold 20,000 shares of Treasury Common for $9 per share. Okay, so we now have more cash, an asset that increased. 20,000 times $9. So we get a debit to cash for $180,000, the increase in cash. Now, I know here, you guys, that we sold the shares for more than we bought them for, right? It's easy to see. They give you the price per share. We sold them on D for $9 a share. We purchased them on C for $7 a share. So what that's going to do is increase stockholders' equity for the company. You guys, they're making a $2 spread here, but they can't call that profit. A corporation can't buy and sell its own shares. Buy its shares at, in this case, $7, sell them for $9, and make a $2 profit per share. Instead, that just increases stockholders' equity. It's not net income for them. Okay, so we put the cash on the books at the amount received. Okay, we're going to take Treasury stock. Off the books at its cost. Okay, we sold 20,000 shares times the price we purchased them for per share, $7 each. So we're going to credit treasury stock for 140,000. The other account to credit is a stockholders' equity account, another paid-in capital account. This is called paid-in capital from sale of treasury stock. And it's for the difference here, 40,000. You could also calculate that a different way, though. We sold the shares for $9, purchased them for $7. There's a $2 spread there, so we could say $2 times the number of shares sold in D, which was 20,000. And we get the 40 either way. Shares sold seems to be hard for me to say for some reason. Hope that one makes sense. What did we do? We increased the asset cash by the amount of cash received. We took treasury stock off the books. It's a contra stockholders' equity account. Decreases on the credit side. We took it off the books at cost, 7 per share, times those 20,000 shares. And then we credited a new stockholders' equity account, paid in capital from sale of treasury stock, for the spread there, $40,000. All right, then on E, we sold 5,000 shares of Treasury Common for $6 a share. So here we sold them at an amount less than they cost. So we're still going to debit cash. Okay, how much cash was received? 5,000 shares times $6 each. It's 30,000. We're going to credit treasury stock for the amount of the number of shares sold times the cost from that we purchased them at back on C, $7. Okay, so we're going to have to credit treasury stock for 35,000. Well, that means we need room for another debit, so I'm going to move this one down. It's no problem when that happens. You just hit cut. I'm going to do this. Copy. Alright, so now what are we going to debit for the difference? What's happened? Paid in capital from treasury stock, our new stockholders equity account, it decreased because we sold the shares for less than we bought them for. We sold them for 6, we bought them for 7. So we need to decrease the stockholders equity account paid in capital from sale of treasury stock. It's a stockholders equity account. It decreases on the debit side. That difference is 5,000. Well, we sold them for $1 less than we bought them for, and we sold 5,000 shares. $1 times the 5,000 shares gives you the $5,000 here. Okay, you guys, and we'll make our dividend calculations coming up on F. That's where the real fun starts, in the next video. Thanks for bearing with me there. This one was organized a little differently than it was the last time I worked it. But if you have any questions anytime, please be in touch with me. I think I can talk you through it. But practice these. We could go back over them kind of quickly. You want to debit cash for the amount received in these first two entries. You want to put common stock and preferred stock on the books at their par value. The number of shares issued times par value. The excess goes into these accounts, paid in capital in excess of par common stock for common stock, and then paid in capital in excess of par preferred stock for preferred. We'll put treasury stock on the books at its cost. It's a contra stockholders' equity account, increases on the debit side. Of course, cash decreased the asset on the credit side. And we increased cash when we sold some of those treasury stock shares back to the investing public. We increased cash, and we decreased treasury stock at its cost. The number of shares that were sold times the amount we paid for them per share, $7. The excess goes into paid in capital from sale of treasury stock, a stockholder's equity account that increases on the credit side. Then, similar situation on E. We increase cash, the asset for the amount received when treasury stock shares are sold. We're going to credit treasury stock at its cost. But here, since we sold the shares for less than we bought them for, we're going to decrease stockholders' equity by the amount of the spread there. And we decrease paid in capital from sale of treasury stock on the debit side. Now, we can only decrease it by up to $40,000, assuming it had a zero balance going into this month. We can't run it into the negative, but since we had a $40,000 credit here, it's okay to debit it for $5,000. If you didn't have a balance in that account, you'd have to debit it to retained earnings. Can't run it negative. Can't have negative stockholders' equity, in other words. Okay, we'll pick up with dividends in the next video. Good luck.